See. Hi, everyone. I'm Beverly Barnett. I'm here today with one of my favorite mortgage brokers, Ephraim Schwartz. He this year has helped a couple of my clients that had, just some unusual needs, and we've worked together in the past a lot. So anyway, I'm going to let Ephraim tell us a little bit about himself, how long he's been in the industry, etc. So Ephraim, good to see you today. Thank you for joining me. And tell me about yourself.
Thank you, Beverly, for having me. Nice to see you as well. I'm originally from Boulder, Colorado. Got my degree in math, University of Colorado, Boulder. Moved to San Francisco in 2000. Worked as an analyst in tech for about 5 years. Went through first dot-com crash and decided that the mortgage industry was where I wanted to spend the rest of my life. My father was in real estate, and it's always kind of running in our blood. And it was a nice equilibrium of service to people and scratching the analytical itch with numbers and real estate.
Nice. I love that. Well, let's dive in to what's going on in the industry. I know it's been an interesting year for me in real estate. What have you seen from a lending perspective in 2023 this year?
Well, things have slowed certainly considerably, and in terms of just the transaction volume. But what we've seen is that folks who have been buying homes are very much of that kind of contrarian, opportunistic mindset. The old saying, Warren Buffett would say, be scared when people are greedy and greedy when people are scared. And really kind of thinking about this as, understanding that relationship between the purchase price and the interest rate. And if you get into a property today, the likelihood, and looking at something we'll discuss, is all these mechanics of what we look at to determine where rates are going to be headed. And the likelihood that if you get into a property today, there's probably going to be a good opportunity to refinance the rate considerably lower and relatively near term. So, probably in 1 to 2 years. And so once rates come down, we'll see more buyers in the market. And so the competition will be stiffer. And that is typically what drives pricing up.
Yeah, it's interesting because I'm trying to get a few of my clients to, get off the sidelines as far as some of my buyers. And of course, I get it, right? Interest rates have been over 8% this year at some times. And, that drastically affects your monthly payment, et cetera. We haven't had a crazy amount of inventory this year, or actually our inventory levels have been low, but because the interest rates are high, there are fewer buyers out there than there would be if, we had those 3, 4, 5% interest rates. So I've always said, well, there's the saying that you date the rate and marry the house, right? And so, because now I feel like a buyer can get into a property for less than they would be able to if interest rates were much lower. So one of the things I wanted to have you talk about today is the cost of money. If somebody waits 6 months, a year, what does that look like, and how may that affect their bottom line? And things like that, because they're paying a higher interest rate but a lower price, right? So anyway, your thoughts on that?
Yeah, exactly. And I think you kind of set that up perfectly. And I read a couple of months ago in a consumer poll that, and this is national data, but that 39% of buyers polled said they were waiting for rates to come down. That's almost 40%. That's tremendous. And so what I think, as we're talking about this cost of money, that's really important to be able to put into tangible, useful context for your viewers and clients, is understanding the relationship in terms of monthly payment and total cost of ownership as interest rate and purchase price affect one another. So I actually put together a little scenario here. And when you assume a 30-year fixed at 20% down, very roughly speaking, a 1% fluctuation in interest rate is the equivalent of a 10% fluctuation in purchase price. So another way to say that is, if you wait for rates to come down 1%, and in that time purchase prices have moved up 10%, it's a wash. And so, and it's not to the penny, but if I can, I'd like to just do a quick screen share here and show you some actual numbers here.
That'd be great. Yeah. I know I'm very visual, so I love being able to see that.
So here's an example of a $2 million purchase price, which is what you see over here as the base case on the left. And you see the monthly payment there. If the rate was at 8%, which is not what it is today, but what, a month or so ago we were looking at. And then as you move to the right here, you see the interest rate dropping 1%, while
Yeah.
the purchase price went up 10%. And then you see that again, another 1% drop in the purchase price and increase in the purchase price. And so what you're looking at there is the delta in monthly payments. And this is at a $2 million purchase price. You see from the two columns a $31 a month payment difference when we're talking about a $2 million purchase price. And then as you go another 10% higher purchase price, and then that jumps to $133 a month. When we look at these numbers over, even if you were to hold this mortgage for 30 years, which you won't, we're
Right.
talking about total cost of ownership difference of 11 to, on the high end, $47,000, which 1 year of 2% appreciation will more than offset that. And then
Definitely.
just to kind of put this in the scalable context so that you say, okay, well, that's what the monthly payment difference is at $2 million. What if we look at something like $1 million? And so at $1 million here, same scenario, the monthly payment difference between the 8% and the 7% is $15 a month. So we're
Wow.
talking really pretty minuscule numbers here. So when we think about how an investment performs over time, I always say to clients, there's really kind of the three things you're looking at, which is the purchase price, the interest rate, and then just the right property. And
Right.
the location, is it the right property for you? All of those things. So when we kind of back up and look at this analysis, and what does that mean for us? Like, well, okay, how likely is it that rates drop 1%, and the return of, or 1 or 2%, and the return of 40% of potential buyers in the market, brings purchase prices back up a little bit. And
Definitely.
that's what will happen. And then you kind of get into, okay, when we're talking about the monthly payment differences, it's relatively small, and that should allow you to really focus on that third variable, which is just finding the right property. And the interest rate's only relevant if you get an offer accepted. And so going out and competing in a slightly less competitive environment and getting the right property in the contract is why some folks are looking at now as a good opportunity.
No, that sounds good. I mean, it's interesting because I know when rates were really low, somebody that was looking at close to a $3 million property could then afford a property at like 1.9 to 2 million when they went to like 6, and it doubled, right?
Right.
Which is a drastic difference in properties. But now I think we would see the exact opposite, right? Because what would happen is these properties that maybe they're at like 2 million or 2.2 or whatever, as more people get back in, it, like you said, it's going to drive the prices up. And I don't know if we'll ever see a 3% interest rate again. So, but even at like a 5%, for the people that have been sitting on the sidelines, it is going to bring in a lot more activity. And what I'm seeing in the market is one of the reasons that we just don't have a lot of inventory is that people don't want to give up those interest rates that they've locked in. And even I have a couple clients that are buying up, but they've locked in such great interest rates on those homes, they're keeping them and renting them out because they're now cash cows, right? So it's going to be interesting to see how long before this kind of shakes out and we sort of have sellers. I think interest rates will have to get down a little bit before some of those people feel good moving out of that. And then, like you said, that demand is definitely going to drive the prices back up. And so being able to take advantage of an opportunity. And again, it's not like it's a buyer's market, where I think when we were in 22, right, and all of this was changing, there was definitely more of like people were a bit frozen. I feel like the last 6 months of 22 was really when things changed. What has been your sense of how many buyers are in the market and stuff like that, and pre-approvals and things, when you
Um,
compare them?
Yeah, you bring up a really good point. And you mentioned with respect to buyers or sellers market and the shift in mentality that I've seen in buyers. I think from my perspective, what happened is we were in, it was such a low rate environment. Money was so abnormally inexpensive. We're in the most desirable place, arguably, in the country or the world to live. And so it felt like such an extreme version of a seller's market. And then as things normalized, we talk about buyers and sellers market with respect to how many months of inventory, really what has happened is just kind of moved to a balanced market. But it's not necessarily where on that spectrum we're sitting that affects people's psyche, but just the movement, right, of where we were going. And it was moving from this extreme version of a seller's market to a balanced market. And that gave people pause. And what I've seen in terms of buyers in the market, the mentality, and some of the, I'd like to talk a little bit about the rates and the mechanics here, is it really did affect the mentality. And then we've kind of hit this point where that shift is kind of flattened or bottomed, if you would, and we're in a neutral market with respect to inventory. And you mentioned the 2 and 3% interest rates. And sometimes folks ask me, do you think we'll see those again? And the answer is, I'm happy for the folks that got them, but I kind of hope not, because if we ever see 30-year fixes in the 2s or 3% again, it's reflective of bigger issues in the economy.
Yeah.
And just a moment on the mechanics of how 2 and 3% mortgage rates ever happened. And the mortgage rates are based on bond prices. And when bond prices go up, corresponding rates and yields come down. And what happened during COVID was initially, I think the Fed was concerned that they thought this response might be something similar to what we saw in the Great Recession, 2008. And they had to support the housing market by printing all this money, buying bonds, artificially pushing bond prices up and rates coming down. And they spent an incredible amount of money, billions of dollars a month, buying bonds, pushing rates up. And what we saw was actually quite the opposite happen in the housing market. Nobody was selling, everybody was buying. Your place and your home or your family slips became the most important thing in the world.
Absolutely.
And actually, let me show you. Just I didn't know if I'd use this slide, but since you just brought it up, let me show you one other here that is really interesting. This I know looks like a lot of numbers to look at, but I'm going to explain it. So Freddie Mac publishes this. It's the average monthly 30-year fix dating back to 1971. I keep this charted, and you can see here, rates in the 7s, 9s, all the way up into the high teens. And what's really interesting here is at the very bottom, I just updated this average. So dating back to 1971, the average 30-year fixed is 7.73%.
Interesting.
And of course, that is skewed by the 80s
Yeah.
when things were wild. But
Right.
it's also skewed by the last, really the last decade where we saw rates in the 3s and 4s and 5s. And I think that if you were to ask most economists, where's a healthy place for 30-year fixes to be, they would say, 5s and 6s are great.
Yeah.
And 4s is on the low end. Any lower than that is a distortion of where rates would be because of Fed intervention.
Interesting. Yeah, I know my first mortgage rate, I think, was like 5%. And I felt so lucky to get that at the time. And then, of course, this was 2003 as well. I mean, we haven't had a lot over 5%, 6, 7, and then until recently. But yeah, it's been more, like you said, on the lower end. And even with my own house now, I'm like, I never want to give up my interest rate, right? So I think for buyers that are sitting there and waiting, who knows how long it's going to be before we see a huge amount of inventory on the market. I mean, and definitely in San Francisco and in Marin, our inventory levels are somewhat skinny. I mean, if you get into the upper price points, you get above like 7, 8, we definitely have more inventory in those price points. But there's to be a different type of buyer. Lots of times they're doing all cash and things like that as well. So.
And with respect to how quickly might we see rates come back down and into that range that will bring some of those, 40% of buyers back to market. Here was another slide just to show you what's happening with the 10-year treasury yield. This is what jumbo rates are based on. And so when the 10-year treasury yields drop, mortgage rates improve. And over here on the left, the slide we're seeing here, this was from late November. And you see here the 10-year treasury yield hit just about 5%. That's when jumbo mortgage rates were had an 8 handle on it. And then the arch enemy of bond prices is inflation. So what we've been looking at is when will inflation come down? And to put that story into context, the two most important inflation reports are CPI and PCE. And CPI peaked after in this last cycle since COVID at 9%. The Fed's target is to get inflation back at 2%. And the last 3 CPI reports have been 3%, 3.2, 3.1. So we've made a lot of progress.
Definitely.
What's happened is it's just taken the bond market. Well, the bond market's really smart. And they're also listening to Fed Chairman Powell's commentary on how confident the Fed is, and the 118 or so PhDs who work for the Fed, how confident are they that we're really out of the woods, that inflation won't come back down? And what the Fed has been trying to do is, this sounds kind of crazy, but they've been hiking rates to try to cool the economy and almost drive unemployment up a little bit,
Yeah.
because they view their top priority as price stability and bringing inflation down. Now that the market believes that the Fed has really done that, we're starting to see yields come down. And if you look at these charts here, what you see is these lines. These lines, the 100, 200-day moving average, they act as floors of support and ceilings of resistance. And so you see here on this chart on the left, this was where the price of the 10-year treasury yield was bumping up right against that 4.35% range. And we
Okay.
really needed some significant news to drop lower. Inflation came in lower, and this is today. So now we're below 4%. This is really significant. And this is why we've seen mortgage rates improve over about 1% or more in just the last month. And if you look here, below, we're really below these floors of support. So as long as we don't get any unexpected bad news on inflation returning, there really is, we're starting to see the 10-year treasury respond, and we could start to see rates, nobody has a crystal ball, but we could see them start to improve here pretty quickly. And that could bring, we're already pricing things, and with a little bit of points, seeing a 6 handle on it. That's a
That's
big
great.
difference from something with an 8.
Yeah.
And I think will play a big part when buyers come back to market.
Yeah, I mean, I think it's going to be interesting to see how the new year is after Christmas, and once everybody's back from holiday and all of that. Lots of times our properties that didn't sell, we sort of we take them off the market, and then we'll reintroduce them in late January, early February. But it's interesting, just in the real estate world, I felt like October and November, it was busy, but it's Christmas, and people are calling to see properties. I mean, I just took a couple of my big listings off, and I have a showing tomorrow on one of them. They're off market, but of course we're still showing them. So it really, the stock market's really performing well. So I think with the latest news from the feds, that people are feeling optimistic. So it's going to be interesting to see how the early part of 24 is. And I know even 23 started out with a lot of optimism, and then we had the banks that sort of fell apart, which was really unusual and really sad. So it'll be interesting to see what dynamics affect us in 24. Do you have any thoughts on that?
Yes, and I was just thinking what you just described about it kind of getting busy and more buyers coming to market. I wonder if you could almost overlay what you've just described with that 10-year treasury yield, where November, and then that was kind of the inflection point where rates started to improve, and you're starting to see buyers like, all right, this is the beginning of what we've been wanting to see. So with respect to your question of what we see happening in 2024.
And I won't hold you to it, of course.
Yeah,
No,
no.
have a crystal ball, right?
Of course, nobody has a crystal ball. Some things to point out. In the beginning, prior to 2023, the Mortgage Bankers Association of America estimated that the average 30-year fixed at the end of 2023 would be 5.3%. They were obviously way off on that projection.
A little
way
bit.
Now, what I would say, as this kind of informs our perspective on what will happen next year, is it's not that the data they were looking at was not real or accurate. It's just it's taken longer for the bond market and therefore mortgage rates to respond to that data. And I
Yeah.
think a lot of that was in response to just the Fed's really conservative approach to, really prioritizing nothing other than getting inflation down. And so I think that if I had to wager a bet, I would say mortgage rates continue to come down. I wouldn't be surprised if we are looking at 30-year fixes in the mid fives this year.
That'd be great.
And I think that that is, as we're resetting our context and expectations, and you look at that and you consider that chart for the average 30-year fix since 1970, I think that's a really healthy place for things to be. Healthy is the word I would use to describe, rates in that range. And then, and one last thing, as you mentioned, I think earlier, that, your first home, the rate you paid. And sometimes folks will share, I bought a house in the 80s and my rate was 16%. And
Right.
people might
Yeah.
say, well, that's cold comfort for, what we're looking at today compared to what we saw 3 years ago. But I think the point is, if you bought a house in the 80s, you're
You'd
you're
be
really
really
happy.
happy. Yes, you bought a house in the 80s. Exactly.
The old saying
Exactly.
is, right, the best time to buy real estate was always 10 years ago.
Yeah, and also like when it's right for you. I mean, everybody's trying to time the market, whether it's like, when a stock is going to dive to the lowest, when's the right time to buy a stock, when's the right time to buy a house. And like you, I think it's not like where we live, there's just a ton of single family homes and a ton of properties in any given neighborhood. Depending, some of the high rises and things like that, there's a bit more inventory. But when you find a house you love, when you drive by, if somebody else was living there, you'd be really upset, because I think it's hard lots of times to find a house you love. So buy the house, live your life, and then you can always, like you said, refinance or whatever down the road, but you're building wealth, and real estate has historically always been one of the best ways to build wealth. And yes, it fluctuates up and down. So if you buy in an up market and you sell in a down market, but you just hold, right? It's like buying a stock, you just hold.
Yeah.
So no, I know, goodness, there's some properties that when I lived in Boston in the early 90s, I almost bought a property on Commonwealth Avenue. And I
Mhm.
remember the time I was like, oh my gosh, this is just so expensive. And I didn't do it. Now I'm just like, why didn't, right? It's like, oh my gosh, I would have just been so happy. So anyway, any other advice?
Yeah, one other thing I thought that would be great to share, and just to put into context, is as you just mentioned, you get in and you plan to refinance the next couple of years, and this is where there's some real strategy in here, right? So this begs the conversation of what type of product do you do? Do you do any points? And how aggressive do you want to be basing your strategy on the assumption that you're going to refinance in the next two years or so? One other thing that's really interesting for folks to think about is the question of what is the best allocation of capital, right? So let's say we're thinking we're going to buy a property today, and most likely we're going to refinance in the next 2 years. What type of product should we do? And if we've got a hair more than 20% down, should we put that money towards increased down payment? Or is it more effective to put that money towards points to buy the interest rate down? And points have a little bit of a stigma, and I think the mortgage world could do a better job of taking the time to explain to folks how to think about
Mm,
this. And so just
yeah.
a quick moment on, the way points work is anytime any loan program is priced out, there's always a rate sheet with a long list of options, and you can do look at the rate at 0 points as kind of the baseline for comparison. And then the analysis that you make is, if you spend some points to buy the rate down, how much did the points cost you at closing versus how much they save you in interest monthly, and when's the break-even time frame. There are tax deductibility considerations to consider, because if you're buying a primary residence, points are tax deductible in the year that you close escrow. And so historically, those break-even timeframes on
Mhm.
points is about 4 to 4.5 years. Right now, we're seeing them the 1.5 to 2 years range. And think about why. Well, banks are thirsty for liquidity, so they're further incentivizing borrowers to give them a little bit of money up front. So here's another scenario put together. And this is kind of the base case again here, a $2 million purchase price. And then let's consider a buyer scenario where they have an extra $20,000 available. And you compare, should they put that towards incremental down payment versus spend it on points to buy the rate down? And what you'll see here is overwhelmingly, the better option is to spend it on points to buy the rate down. And so this scenario here shows you kind of the difference, the 1.6 loan amount. Here it's $20,000 lower, but here you've got a lower rate, and the monthly payment, is about $400 a month less. And so that's the first point to understand. The second is, okay, then, what's the break-even time frame? How long are we going to hold this mortgage? And then the third question is, based on what rates are the day you're closing and where you believe rates will head in the next 2 years, do you think you want to plan to refinance in the next 2 years? And all of this factors into the strategy of getting a property at the right price and then financing it such that you'll have the lowest long-term cost of ownership.
Well, it's interesting. I think this is such a great idea. And one of the things that, even with buyers right now, a lot of buyers in the market are focusing only on the price that they're able to negotiate, right? So like if a property's 2.2, being able to get a seller to come down to 2.1 or whatever. And so there's some other ways to go about saving money besides just a lower price. And some of that is having the seller buy the rate down a little bit. And I've only done this with a couple of my clients, but like for me, that seems like, especially just with what you've shared, it would be so much better. Say it's $100,000. Maybe you have the seller pay 50,000 to buy the rate down, and then you take 50,000 off the price, and then you're going to end up with a better monthly payment than you would if it was just $100,000 price reduction.
That's a great idea, and it's a great strategy, and I've used that as well. Basically, like you said, let's say a buyer is wanting to say to a seller, I'm willing to pay $1.2 million, but I'm going to write the offer at $1.25 million with a $50,000 seller credit, which I'll use to spend to buy my rate down. This improves the buyer's purchasing power, improves their monthly payment. And one other thing to mention there is, if you structure it that way, even if the seller credit is covering the points for the buyer, the cost of the points are still tax deductible for the buyer. Now, I have to caveat, I'm not a CPA, so you have to check your CPA
Right,
about tax advice.
Yeah.
But I can talk generally about the tax code, and that's something we know to be true. So yeah.
There's a lot of creative ways. And so that's why I think in markets like this, I think that there are buyers, like you said, that are just sitting on the sidelines and they're waiting for a rate drop before jumping into this market. And there's so much, we're seeing a little bit of seller financing right now on certain properties. I mean, there's just so many ways to be creative. And so you don't have to wait until that rate drops back down to where you're loving it again, or you're at least liking it. Take advantage of fewer buyers in the market, and then in time, whether it's the buying points down, or you're paying money to buy the points down, or refinancing, but just, I think, reaching out and really having a conversation with a mortgage broker and your realtor, and how to be successful in this market when we did see such a drastic move. We saw everybody just kind of like put the brakes on and all of that, but there's opportunity in every market. And I love that saying, when there's a lot of fear in the market, and fear, people just really react weird. But when people are being fearful, that is the time to act so many times, because of the opportunities that it presents. Same with the stock market. When those stocks fall really low, I mean, scoop them up, depending on what they are. I'm not an investor either, but like I said, my business in the last month, I feel like I'm seeing more people reach out for showings. Are you seeing more buyers reach out for pre-approvals and things like that right now?
Yeah, and I think all that was really well said. Yes, and it's a lot of it has been people who we were in contact with for quite a while,
Okay.
and kind of took a pause, and they're starting to say, okay, well, let's see what's going to happen here. and wanting to get ducks in a row and starting to look. And so, yes, we've certainly seen that pick up a little bit relative to the last 6 months or so.
Yeah, good. Well, I'm excited. I think we're going to have a great year in 2024. The thing I love about real estate, I've been doing this for 24 years now, and it's never boring. And sometimes it's extremely challenging. And whether you're working with buyers or sellers, it's so fun helping people. It's a dream, right? For so many people to the American dream, to have a beautiful home to live in, and a great investment. So I just absolutely love it. And I can tell you do as well. And your creativity with one of my clients, I was just so happy with. So thank you. Thank you.
Thank you. Well, it's fun to team up with great people to do great things for clients. It's really fulfilling and fun, as you said. That's one of the things that I think some folks either miss or don't know, is how fulfilling what we get to do is.
No, definitely.
Yeah.
Ephraim, thank you so much for your time today, for joining me. I'm sure I'll see you on a deal here soon. So have a wonderful holiday.
Thank you for having me. Always here to help.
All right. Take care. Bye.
Bye.